Hey, this is Chris, and in this video I'm going to be talking about my SMSF investment strategy. Now, the reason I decided to set up an SMSF was really threefold. So first of all, I really wanted to be able to invest in some particular ETFs that at StockSpot I was recommending to clients, but most of the big super funds won't actually allow you to invest in because most of them are trying to funnel your money towards their own funds. But ultimately, I thought these ETFs were going to give me the best chance of reaching my long-term goals. I also wanted to make sure my super money was invested in a really low-fee way. And while there are some good low-fee funds out there, there are other big costs like administration that unfortunately even some of the biggest super funds in Australia have been increasing. So I saw a couple of years ago the admin fees of my super fund almost double, and it was with one of the biggest super funds in Australia, which I thought was really unacceptable because low fees are what's going to help me get good long-term performance. And then I guess related to that is transparency. I really wanted to always understand what I was invested in, and the lack of transparency in some of the big super funds, really made it hard for me to be comfortable that I knew what the underlying investments were, what holdings I had, what companies I was invested in, and with some of the unlisted assets, I was a bit worried about how infrequently they were valued and the valuation methodology, and the impact that could have on my long-term returns. I try not to check my account too often, so I would probably check my SMSF once every month or two, just out of curiosity to see how it's gone. Now at the start of 2020 there was a big dip in the market, so I probably logged on a couple more times, but I knew I shouldn't be logging on too often. But fortunately within a few months those losses from that first period of 2020 had been recovered, and the account is now well in the positive again. I think if you want to be a little bit more adventurous with your SMSF, that's totally fine. I mean, one of the main reasons people do set up an SMSF is so they can have a bit more control over their investment strategy. I'm pretty conservative and pretty boring with my SMSF strategy because my philosophy is that boring is brilliant. So we're exclusively invested into low-cost ETFs via StockSpot. I occasionally pick investment themes to tag onto our SMSF. As part of the StockSpot themes, which is one way to be adventurous. Over some periods I've held some Chinese shares and some Japanese shares. Right now I own some gold miners because I think that's going to be a good investment. But if you want to go outside of the world of ETFs, I mean, there's all sorts of different assets that you're allowed to invest in with an SMSF. You can buy direct shares, you can buy property, you can buy things like Bitcoin, you can even buy unusual things like art and whiskey. There are obviously some things that you need to think about before you invest in these other alternative assets, like their liquidity, their risk, and their returns. But also it's really important that anything that you invest into in your SMSF, you don't personally use, because it's one of the rules that you can't actually personally benefit from, let's say, a property or whiskey in your SMSF. It has to sit aside as an investment alone. I think there's a lot of excitement that goes alongside setting up an SMSF, and it's probably tempting to want to take a lot of control and make a lot of more unusual investments or exciting investments. I would say my one tip would be, at least when you start setting up your SMSF and start investing, keep it simple and keep it boring. As you get more experienced and confidence and have the ability to invest in more in the future, that's a great option to have. But specifically if you're investing as a 30-year-old or 40-year-old and setting up your SMSF, while you're still relatively young and have a long time until retirement, you don't need to take a lot of risk. You just need to get good compound growth by investing into low-cost funds and then topping up obviously with your salary and your super guarantee.